A very good afternoon, a very good morning. Welcome to HYCM's workshop with myself, Giles Cochran. Hope everybody's doing well. Aaron, Max, Setley, good to have you here. If you can just let me know you can see my screen and hear my voice okay, that would be super. Always gives me a good reassurance to know that my voice on the screen is coming over all okay. If you have any questions, please do just pop. Thanks, Max. Always appreciated. Excellent, great. Well, today, as we get going, don't forget, as we're looking at different entries, exits, the whole idea of these workshops is you look over my shoulder, someone with a professional trading background. I'm relied on by hundreds and hundreds of traders, and I give professional analysis across major asset classes for big media organizations. The whole idea is not to be blow my own trumpet, but it's to say the concept of these workshops is you look over my shoulder, you see how I go about making trading decisions, and that's idea is that is a model to follow and a pattern, not that you follow my trades exactly or anything like that. It's not a signal trading service, it's more a concept of learning and understanding the markets. And of course, today is the big one. It's trading the FOMC meeting, the Federal Reserve, and there is an awful lot of detail in this, so we'll be just getting through. Hi Kirash, glad you could make it. One sort of fundamental concept, if you're either new to trading or relatively new to trading, what you're always looking to do is look to back strength against weakness. If you take nothing from these workshops, this one concept will at least put you in the right direction, which is when we're trading, we want to back strength against weakness. So we want to pair a strong currency against a weak currency. And in that way, we can increase the probability of the trade going in our own direction. And there's obviously nuances to this. So it can be a weakening or a strengthening currency, not just a strong and a weak currency, if you can see the difference. Or it could be the fact that a currency has been very strong for a very long time, and now we're expecting a little bit of weakness. So there's obviously nuances to that, but that's a key fundamental aspect to look at. Because there's so much to look at, we're going to jump into the start of the presentation right away. Now, what you'll notice if you look at these charts, this is the major currency pairs. And if you're just sort of new to trading, you want to focus on trading these currency pairs. But what you'll notice is that the dollar has been surging higher since the start of the year. And if you just zoom out, this is the weekly chart, you can see that the dollar has just moved up to this overhead resistance level going back to 2017, 2020. And if you zoom out even further, you'll see that the dollar hasn't been at these levels since around 2002. So you're looking at a sort of, around the 20-year high that the dollar's trying to move into, and just tried to peak over that 103, touching on that 104 level last week. Now, why is the big run up in the price? Well, the big run up in the price is on expectations of the Fed being very aggressive in their hiking policy. Now we have the meeting. What markets often do, and they're just sort of getting cagey now ahead of the FOMC meeting, because no one wants to put on a new position just before the Federal Reserve meeting. Okay, so it's just patience. And at the meeting, the Fed will reveal to markets exactly what they're thinking about the path of interest rate hikes. Now, the key concept to understand here is that the Fed is hiking interest rates in order to contain surging inflation. The headlines are 8.5% in the US. Inflation is a problem to economies, because if inflation gets out of control, then savings become less valuable. You get inflation causes higher inflation, because people think, well, if I'm going to have to buy a product in the next 6 months, I may as well buy it now, because it's going to be more expensive in 6 months' time. That in turn increases inflation more and more and more. So once inflation gets really hard baked into economy, it can be very tricky to get out. So the Fed has to control surging inflation, but, and this is the difficulty the Fed has, if they hike interest rates too quickly, then they're going to risk slowing growth. So in other words, the Fed may end up having to hike rates aggressively in a way that causes the US to fall into a recession. Now, just out of interest, a couple of points to note. So first of all, this is the historical S&P 500 correction since the mid-60s. And you can see that historically, the average correction is about 21% lower in the S&P 500. Once the correction goes above about 23%, you can see the red dots here, that's when the US economy, with only one or two exceptions, went into a recession. So if the S&P 500 corrects above about 22-23%, there's a high probability that US is going to fall into a recession. Now, if we just take a look at the major US indices for a second, let's just drag them out here for a second. And let's just look at the S&P 500, for instance, okay? We can see where is a sort of 23%, 24% drop. Let's have a look. So we just pull up from the highs of January, and we see, look, about a 23-24% drop is around this sort of 3700-3600 region. So once you start getting sort of 38, 37, 36, that's the kind of level where you can potentially see a recession. Now, we can see at the moment the S&P 500 is just bottoming out around that 4100 level, and that is a, you know, that's a bullish reversal hammer bar, just rejecting that 4080, 41 region. Now, what I want to look for here is reaction during the decision. Now, if the Fed are dovish, then you'd expect stocks to correct higher, and you expect to move back up to 4.3 as a first port of call for the S&P 500. And I'm just going to go through what we should expect markets to do as we come into the decision. Now, I'm using here some excellent research from Financial Source. I work as one of the analysts at Financial Source, and this is a report put together by one of my colleagues, Arno. It's a very good report as we look forward to the FOMC. So I'm just going to run through that with us. Now, the Fed, you can see now, are projected to hike interest rates 9 times before the end of 2022. And you can see that the implied interest rate curve is that the interest rates of the Fed will be up to 2.71% by 2022. So that's 9 interest rate hikes expected between now and 2022. That means that short-term interest rates markets are pricing in a 50 basis points rate hike today, and then 2 more after today. So there's 3 back-to-back 50 basis points rate hikes priced in, and the announcement of the end of quantitative the start of quantitative tightening, the end of quantitative easing, right? So that means that how does the Federal Reserve get more hawkish than these expectations? That's what they have to do to send the dollar moving even higher. Now, what's expected in terms of quantitative tightening is the runoff is expected to be 95 billion per month, 60 billion in treasuries and 35 billion in mortgage-backed securities. Now, if there's a higher reinvestment cap of like greater than 120 billion, that will be more on the hawkish side. So at the moment, possible start at the end of May or start of June. That's what's expected, right? So QT to be announced end of May or start of June, a 50 basis point rate hike expected today, and signaling 2 more, so a total of 3 back-to-back 50 basis points rate hikes. Now, remember the last interest rate hike in March, what happened is the Fed was hawkish, but not hawkish enough. So what we're looking for here, we're looking for not just a hawkish decision. It's going to be a hawkish decision, but is it a hawkish decision that's above the market expectations? And the market expectations are very high. That's why we could potentially see a buy the rumor, sell the fact response. Now, just as a quick aside, if you just take a look here at the HYCM blog, and you'll see here that I have, where is it? Let me just show you. I've put here a buy the rumor, sell the fact response. Yeah, and that is just going through what I'm expecting for the FOMC. So I'll just pop this here in the question and answer box so you can see it. This is my blog, and I update it every single day, okay? with breaking news, always set that central bank watch, and I go through different currency pairs, you know, what to expect from the upcoming BoE meeting, you know, what we can expect from the RBA. And you can see that, you know, I was looking at the RBA and, you know, the potential trades, you know, et cetera, et cetera. So do check that blog out, because it is a blog that I regularly update, and it's kind of, in inverted commas, my blog with my material. Almost all of that material on that blog is mine. Now, oh, sorry, just had a little cat walking across my keyboard. Right, now, this expectation today, remember, we're not just looking for a hawkish decision, we're looking for a decision that is more hawkish than the market's expecting. So in March, the meeting was hawkish, but it wasn't hawkish enough to sustain the aggressive rally we've seen in the US dollar. Now, if you just take a look at the US dollar and US 10-year yields moving into the decision, to see how much the dollar's been gaining since January. So market expectations are really expecting, you know, an aggressive response. Nikita, where can you see exact volumes of the FX pairs? You can't see exact volumes of the FX pairs, Nikita, unfortunately, because FX is not a centralized market. So all you can see, Nikita, in terms of volume for FX pairs is you can see maybe what individual brokers have, but getting volume, you know, you can't get it. Commodities, again, you might want to look at things like, you know, ETFs. What is the holding of ETFs for, say, gold and silver, and then what's the physical demand for gold and silver? You want to look at something like gold.org. I think they have some data there for silver. They might have something else for, and then you have to look at other commodities for volume. So what you can see is hawkish expectations are well and truly priced in. So the trade is as follows. If we see a more bullish catalyst, that would be a 75 basis point hike. And if the Fed says more 75 basis point hikes are coming, then look for the dollar index to break higher, and I would trade the dollar index clean. So just trade the Dixie higher. If they announce a bigger balance sheet and reinvestment cap, so if it's above 95 billion per month, that's hawkish. Again, expect dollar upside. If there's a possibility of outright asset sales as soon as Q3, that's hawkish for the dollar. Dollar upside, dollar index. Look for a breakout of those multi-year highs. Okay. Okay, Nikita can't hear. Can everyone else hear my voice okay? Let's have a look. Yeah, Kiresh can hear it. Yeah. Now you can hear. Great, Nikita. Okay, that's super. I'll yeah, well, just quickly, Nikita, FX volumes you won't be able to get that. Thank you, Aaron. Is this webinar being recorded? No, yes, it is. Nikita, FX volume for pairs you can't get, because you can get it like maybe from one broker or what another broker has, what IG has, what Oanda has, but you can't get centralized volume. So volume is less useful in trading FX. And for commodities, you want to look at things like physical demand, gold ETF levels, and you can look at things like gold.org or look at some commodity based websites. Yeah, thanks, Aaron. Thanks, Nahar. Okay, so the bullish catalysts are, no concerns voiced about financial conditions or recent volatility in markets. So remember what I was showing you with the S&P 500, that those falls. So if the Fed's, I say we're not worried about the recent volatility, that's hawkish for the dollar. It means the dollar can keep gaining. It means interest rates keep hiking. Now, if interest rates move higher, that's a natural pressure on equities. So this would result in equities falling. Now, why is that? It's for the simple reason, it's also with growth. Now, if growth keeps moving higher, so as long as companies keep making profit, then interest rates moving higher can be absorbed. And that means that equities will rise alongside interest rates. But, and this is the concern from like companies like Netflix. You remember Netflix those subscriber earnings came in like 200,000 below the expected, and then Netflix revised lower their subscriptions for the next quarter, that they thought they were going to lose 2 million subscribers, and there was this like huge drop in Netflix share price. Well, that is all on concerns that growth will be slowing, and that can weigh into the major indices. So if the Fed's really aggressive and there's worries about slowing growth, then you get another leg lower in stocks. So that's why many professional investment houses have been shorting stocks and are looking to sell stocks at the moment. Okay, that's the professional, general rule of thumb. And this outcome that's bullish for the dollar would also be negative for stocks, but to keep the growth story in mind. Now, if we get the consensus outcome, and remember that is already bullish, so if they hike by 50 basis points, they signal a few more appropriate as priced into the short-term interest rate market. So that's 3 back-to-back 50 basis points rate hikes, taking it up to a terminal rate of about 2.5% by the end of the year. That's just the consensus view. And I would anticipate seeing a buy the rumor, sell the fact response. So if we see QT starting in June at 95 billion, similar hawkish tone and language in line with the recent Fed rhetoric, getting on top of inflation. If they acknowledge recent market volatility but don't convey any real concern about it, then I expect to see that weakness in the dollar, and that could give a little uptick in stocks. But I would prefer to trade dollar weakness in that scenario. And I'll show you the currency pairs that I'll be looking for. Right? Yeah, great. That's great, Nikita. Now, bearish catalyst. What you're looking here is if they only hike by 25 basis points, that would be a sell in the dollar. If they announce smaller balance sheet reinvestment caps, smaller than 95 billion, again, sell in the dollar. And if they express material concern about financial conditions and recent market volatility, again, sell in the dollar. Now, these are the currency pairs that I'll be looking at: the euro, the pound, and the Aussie US dollar. And I'll just show you how that works and which one I prefer. Now, my favorite currency pair to trade on the Aussie US dollar is the Aussie US dollar. One, we're in that nice support level here. Two, do you see that bond yield spread? Do you see how price tracks the bond yield spread? Look at that. Look at the way that yield spread's surging higher. Now, the yield spread will either drop lower to price or price will move up to the bond yield spread. I would favor buying the Aussie US dollar if we get a bearish, buy the rumor, sell the fact response. There's a great opportunity potentially there. Stops can be placed just underneath that 0.700 region, or to be safer, just underneath 0.6950, and looking for a retest up to 0.7300. That would be on a bearish response. The other opportunities would be things like the euro US dollar, as well, would be up. You'd expect upside in euro US dollar. The problem with the euro is that it's very closely exposed to Russian-Ukraine risk. So you'd expect a snap reaction, though, higher in the euro US dollar if there's anything bearish. The other ring is just to trade the dollar index short on a bearish outcome, and then look for a retest around that sort of 101 region. And the other option that looks good is the pound US dollar ahead of the Bank of England meeting tomorrow. Now, the Bank of England are meeting tomorrow, and there was a headline report I saw today that the Shadow Monetary Policy Committee, 6 out of the 9 members see a case for the Bank of England making a 50 basis point rate hike. Okay, so that that was pretty interesting. If you just look at the report I put up here, there was some really good research done by ING, and here it is: what to expect from the upcoming BoE meeting. Now, if we have a look here, what ING are expecting is 25 basis point rate hike. Now, if there's a 50 basis point rate hike, we'd expect the euro pound to push significantly lower, and you could do a sell on stop in case that happens. So watch out for that. And that would be if the Fed are trying to front load tightening. So in other words, if they want to tighten quickly, then they would hike by 50 basis points. So watch out for that. At the last Bank of England meeting, there was some interesting development, is that one voter, that was Bank of England's Cunliffe, decided not to vote in favour of a rate hike because Cunliffe was worried that UK citizens were struggling too much in terms of oh, sorry, I've just got an alert keeps going off. Sorry about that, it's distracting me. They were concerned about the UK consumer being under too much pressure. So, you know, there's been higher taxation in the UK, energy prices, the cost of living, all of that has become very difficult for UK citizens. As a consequence, Bank of England's kind of voted against a rate hike. Okay, so if we see more people joining Cunliffe and voting against a rate hike, expect the euro pound to surge higher. But remember, the shadow board today has said that they were in favour of a rate hike. 6 out of 3 were in favour of a rate hike. Okay, so that means the picture's a little bit muddied since I did this report. So my current view is a little bit more tentative than it was in that report here, based on the latest information that we have. So I was selling the pound Australian dollar this week into the RBA meeting, and I've just taken profit at that level. You may see my updates on that online. But what I want to look at here as well is the euro pound. So the euro pound, if we get a surprise 50 basis points rate hike, you expect the euro pound to sink, you know, retest that 0.8250 level again, certainly at 0.8300. So watch out for that. And one way around it, you know, if you just want to trade a surprise decision, you can have a sell on stop, just about 15 to 20 points below price. And then if there's a surprise move, then price will just sort of sweep down lower, and you just get, you know, taken in with the position. So at the moment, this is a more bullish outlook for the euro pound. I've closed my euro pound longs now, just because I'm nervous of the Bank of England meeting. But medium term, if the Bank of England sort of turn any dovishness at all, then look for euro pound to break higher, because the ECB look like potentially rate hiking in July. So that's why we've seen the euro pound gain. Now, in terms of what medium trades are open today, well, one medium trade open today is the Australian dollar CAD. The RBA took a very hawkish tilt at the last interest rate meeting, and they hiked by more than the market was expecting. They hiked by 25 basis points rather than 15 basis points. Check out my blog at HYCM for more details on this. And Bank of England's Governor Lowe also indicated that further interest rate hikes may be due to come. That's why we've seen the Australian dollar gain. Now, the Canadian dollar is close to peak hawkishness. So I've been long the Australian dollar CAD from yesterday's meeting around the sort of 91367 level, and as price dipped lower, I bought in around that 9100 level. I just bought in 2 positions. That is still suitable for buying. And if you just look at the bond yield spread, you see how that bond yield spread is surging higher. That's the Australian 10-year, Canadian 10-year bond yield spread. And the bond, you see how price follows the bond yield spread? The bond yield spread is essentially an indication of how the currency is doing. So look, this is just, you know, wanting to rip higher in line with the bond yield spread. Stops can be placed very tightly just underneath that 0.927 region, and look for a potential retest of that 0.9250 region. So that's a couple of trades I've got on, just because the outlook looks good for Australia's economy versus Canada's economy. Okay, folks, that's the key data points to be looking at. I hope you feel that got some value out of that. Don't forget, we'll be back here on Monday, and on Monday we'll be getting ready for the next week and the week ahead. We've got a deputy governor from Australia speaking on Friday, which is worth looking at. We've got German consumer sentiment coming out next week. We've also got US inflation data midweek. So a few different data points to look at, but this is the major week, and what we want to look for now is this dollar move. And one final word is, remember, you get the statement will come at 7 o'clock, and then you'll get the press conference shortly afterwards. Remember that often you can get very choppy action in between those times. So you've got the overall crib sheet. If you haven't taken a note of the bullish bearish catalysts, do take a screenshot of that. As I said, it is courtesy of the team over at Financial Source. I do work as one of their analysts, and you could take that as a little crib sheet. Okay, folks. Yeah, I'm glad that was helpful, Max. Very good. And tune in on Monday, and I'll get us ready for the week ahead, and we can unpick what happened as well. So I will explain on Monday what the developments mean, what it means for the dollar, and also, you know, what does it mean for the Aussie US dollar. Real opportunity potentially in the Aussie US dollar. I mean, you just got to mark that. That Aussie CAD long looks good. The risk to that trade is what's happening in China. So don't forget that China's economy has a strong impact on Australia's economy. So in other words, when China's doing well, Australia's doing well. When China's doing badly, the Australian dollar tends to do badly. And the problem in China at the moment is their zero COVID policy, which means that, you know, you get a handful of cases and they lock down a city. So that really drags on growth. So you've got Beijing, Shanghai, and these lockdowns, various other districts, various companies unable to work in the way they would like to, because of China's COVID-free policy. So for me, the one, like, gosh, this would be a great trade, is if you suddenly saw the end of China's COVID-free policy, expect the Australian dollar to surge, and then, you know, as I said at the start of the webinar, you've got just back strength against weakness. That's what you're always looking for. That's what I do. That's, you know, the service that I provide. Just helping people think like this, and then helping people sharpen their thinking so they can make sure they're backing the strength and the weakness. Folks, been a pleasure as always. Thank you, Aaron. Thank you, Setley, Kirash, Max. Take care, everyone. Trade safe, and look forward to being back on Monday. Thanks, everyone. Now, goodbye. Oh, just say, if you found this helpful, if you could just give me a like or a thumbs up on Twitter or something, it just helps with the, you know, just gives me brownie points, which is good. Thanks, folks. Goodbye.